Ready to go. Hey, it's Drake Griggs with Obsidian Wisdom. It's always a good time to be together. Thank you for joining me for another Retirement Readiness Thursday. For today, our discussion is going to be around the idea of investing, and not only investing for your retirement, creating that additional stream of income from your money working where you can stop. Ideally, what the general rule of thumb is, when you're starting, obviously you're trading your time for money. You can start gathering the money. About halfway to retirement, ideally half of your income is being generated from your money at work, half of your income is being generated from you at work. Now that doesn't obviously work for all of us. We have kids, we have responsibilities, we have debt and student loans, all this stuff that sometimes has us having to wait a little bit longer. But it's just simply a good rule of thumb, just to kind of have in the back of your mind. And then as you're getting closer and closer to retirement, we want to get closer and closer to 100% of our income is being generated by 100% of our money at work. So we will go through a couple of strategies today. We're going to focus on the idea of, hey, Dre, how to invest in retirement without losing sleep during market volatility. Because for this to work, we know two things. One is we can't lose all of our money. And two is we have to keep investing our money. And we'll talk about things like inflation and other things along the way. Because the reality is we cannot just put our money in a mattress and say, you know what? Market's going crazy. I'm going to take my money out of the market, sit it in my mattress, and then I'm just going to leave it there. Because the truth is that our money is going to lose value. That if you put what would have been considered a fortune in a safe 100 years ago, and you could say, I don't know, you could say $1 million, you could say anything. Well, you would need $11 million today to have the equivalent of $1 million 100 years ago. And so just that simple idea lets you know that we have to be investing this money in something. And so we'll go through some strategies that you need to make sure that you have under control so you don't feel uncomfortable during these times of market volatility. Today is March 20th, and I'm looking forward. If you have any questions, we'll do the Q&A throughout, and at the end, just ask me the questions, and then I'll try to get to them as we go through this. And hopefully you can see me, because I do know sometimes I'm not actually streaming as well as I think I am. So that's always good if you can let me know if you don't see me. And I have a new screen that I'm going to share with you where I have been having difficulty working through one of those whiteboards that I've been working on. And then somewhere I saw that Canva had a whiteboard, and I was like, all right, let me try my Canva whiteboard. So that's what we're going to try today. And so we'll see if it comes through a little bit clearer. There's really two things that we have to understand and know, right? So I'm going to go ahead and I'm going to share my Canva screen with you, and then hopefully everybody can see that, and then we'll be able to kind of go from there. But really, when we're talking about, okay, all right. I was trying to make sure I could see myself. All right, so I'm not going to double stream me, don't you worry. But I did want to make sure that I can actually see my whiteboard, and so hopefully we will. All right, what you really have to know is two things. Number one is, naturally, we have to know when we're putting our money in, and then we have to know how we're going to take the money out, right? Like, I try to keep things nice and simple. I don't want us feeling stressed out about this. We need to know where to put our money, right? So where to put our money. And we need to know when and how to take our money out. I apologize for my handwriting. I'm already apologizing ahead of time. That ultimately is going to be the two things that we need to know. That determines whether we made all the money or we lost all the money. And so I'm going to start with, where do you put your money in the stock market? And then we'll go through some criteria that we'll normally look at. And we'll also discuss different things that you could do as far as just ways for you to be able to sit there and say, all right, well, if I'm investing my money and I want to make sure my money lasts a long time, Dre, I want to make sure that this works for me. And so we're going to go through a few of those. Now, when you first start, whether you talk about volatility, one of the things that most people are concerned about is this thing called sequence of returns, right? Sequence of returns is a very fancy way of saying that I lost more money in the beginning of my retirement than I lost at the end of it. And in fact, you can actually see, and I will share with you one of those charts where you can see that the sequence of returns, the way that it works is, if I took someone's investment returns. And I was sitting there saying, if you take what someone's overall return would have been, so I'm going to share an image with you, and we'll wait a second so that you can actually see the image. What you'll notice in this chart is the blue investor is actually going to be receiving 105,000 more dollars solely because of the way that their return started, where they made their money when they first started their overall retirement versus someone that had been losing their money when they first started. So what you'll see in this chart is the very first year we had a 9% return for investor blue. You see the second year we had an 11% return, 18, and then it went on and so forth. And then they started losing money around the end. You can see that in the 11th year we lost 4%, 12th year we lost 8%, then 15, then 6, then 5. Right, so that is what you can see. What we often don't always know, but what you'll see is the green is actually the exact same returns, just flipped in reverse. So instead of us gaining 9% the first year, we lost 5% the first year, which is what the last year was for the blue investor. The second year, we lost 6%, which is what the 14th year was. So you can see that it's going in reverse order. And what ends up happening is you're basically digging a hole for ourselves in the beginning. And if we're digging a hole, that means we're not just having to get 5% back the next year. We may have to get 8% the next year just to get back to breaking even. And what some people would do when they would retire, they would say, all right, how's the market looking? Okay, if the market looks good, I'll retire this year. If the market looks bad, I'm going to wait until the market looks good again. But what happens if the market looks good when you're retired in January, and the market looks kind of rough in March, and you're still dealing with your return on that first year? It doesn't have to be 2 months. It could be 10 months into your retirement. But what if that first year is a rough year? And so for many of us, what we're thinking is, I'll just see what the market is going to do. And based on what I see, I'll know if I should retire or not. But that is not always the case. So that's the first thing that we're looking at, is what we call sequence of returns. That's why understanding when to take our money out is ultimately so important. Naturally, the other concern is, if what you're saying is true, Dre, if I do everything right and my check is now coming from my investments, and the money is working for me so that I have all of my time back, then what happens if my money, gets fired, stops working, and I lose in the stock market? Well, then your paycheck stops coming in. Naturally, that's the other thing that we're trying to make sure we're being ahead of. And then naturally, just the psychological impact, we'll also talk about. Very fancy way of saying that you and I, we don't like losing. We don't like risk. So whenever we have a win, we feel like, hey, good job. If we have a loss, we feel like the world is crashing. What am I going to do? And so we'll go through a handful of ways to put your money in and some of the strategies as far as you deciding how to take the money out. The big thing I want to make sure that you understand is we can't be trying to time the market. So there's lots of graphs on this. I'll share one with you. And we'll wait a second so that you can see it. And all this chart is, and Bloomberg put it together, and they do it every year in a variety of years. And all the chart is basically saying is, when you're dealing with market volatility, don't give in to the emotional reaction of, I've lost money, I need to leave the market. I remember meeting with a person who told me that he's like, 2001, my mom lost a whole bunch of money, and then she took all her money out of the market, and I've never invested in the stock market. And I'm like, never? And they're like, yeah, I don't like the stock market. Fortunately for you, you already know there are 3 asset classes you can invest in, right? You can invest in real estate, you can invest in a business that you personally own, or the stock market, right? Those are basically going to be your 3 choices. So as long as you're invested in one of those 3 asset classes, we can get you the 3 streams of income that 65% of self-made millionaires have, because I want you to be able to retire and not have to worry about anything. But in most of those asset classes, there is the real risk of you losing money on any given year. If you have real estate, you can lose money. You know that. You could have tenants that move out and then you don't fill it in right away. You can have values on your homes going down. Same with your personal business. It says like 85% of businesses go out and that like they're done in the first 5 years of operation. So we know that for us to generate income, we do have to take on some risk. But the important thing I want to show you with this chart is the idea of timing the market, not timing the market. And so what we did in this chart, basically the way you're going to read it is from 2001 to 2020. You can see that the total returns, if you never took your money out of the S&P 500, you would have had a return of 7.5%. Right? That's how we're reading this. So let me zoom in a little bit because Ronald had asked me, he's like, could you zoom in a little bit better? So let me do that. So 7.5%. You can see the next one says if we miss the top 10 days, all right, zoom out so you can see them all. So if we miss the top 10 days, so I saw the market went down, I took my money out. I'm gonna let you in on a secret. More times than not, the market has a huge rebound within a month of its big loss. Because normally what happens is we overcorrect. We're selling, 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 selling. And then all of a sudden we're like, I don't want to be left holding bags. Everyone else is selling, selling, selling. But the reality is those people that left at the beginning are buying at that lower price, right? So they have said, oh, I'm going to start buying. And as a result, it ends up having a market rebound. And you've seen that just in 2025 by itself. That if you look one day, we lose 600 points. You look the next day, we gain 700. You look the next week and we lost 1,000 points. And then you look the next day and you gain back, I don't know, like 600. It's not that you gained it all back, but the biggest days are always tied to the biggest losses. So if you were sitting there trying to time the market, then you will most likely miss some of these big marks. And as you can see, if you just missed the 10 best, we're talking about over literally 20 years, 2 decades. If you missed the 10 best days over 2 decades, then you only have a 3.4% return. You're basically keeping up with inflation. 10 best days now, 365 days every year, 20 years, you missed the 10 best days. You're in the market 99% of the time. 10 best days, 3.4%. If you missed the 20 best days, then we're at 0%, right? 0.1%, 0%. I put in 100,000, I got 100,000. I lost to inflation. That means I have less money than I actually, in purchasing power, that I have less money. And then if you missed the best 30 days, the best month, right? So they said 20 years now, 20 years. There's 12 months in each year, but if you missed the best 1 month, you lost money from your investments in the stock market. And then if you lose the top 40 days, then you're down 3.4%, right? So you lose money if you miss the best month or more over 20 years, which is why for me, the way that I think of it, the moment that the stock market starts going down, in my mind, I'm thinking, okay, Dre, what investments do I have that maybe I wouldn't have held if I knew that this was going to happen? And then I would mark them down. And then I'll say, okay, I'm going to wait for the market to rebound. I'm going to wait for the growth. I'll wait for everything to come back. And then next time that we're in a time of prosperity, I'm going to start shifting my positions, right? I'm not trying to sell when the market is down because it's just not going to work. But everybody, when we deal with volatility, right, people call, I have to talk you off the ledge. Hey, it's okay. This is what we're seeing. This is why the market is doing this. But the reality is, as soon as we start losing money, in my mind, I'm selling nothing. Well, I got the losses. I'm selling nothing because I know, historically speaking, over a 20-year, over the life of the market, that if you miss the best days, and the best days are normally right after the worst days, then everything's for naught. That I basically ruin the next 10, 20 years of my investments, which is crazy, right? And so I definitely want to highlight the fact that when you're dealing with market volatility, the idea is to be in the market. We're not trying to time the market. We're trying to stay in the market. And so we do need to overall keep that in mind. So then when we're talking about building our portfolio, when we're talking about putting our money in so that we can grow, we don't have to worry about some of the risk. Ultimately, the way that I'm going to talk about it is twofold. One is we're going to talk about it from where do I put my money? And I'm going to give you 3 examples of where you can put your money that's going to deal much better with market volatility. The idea that we're really trying to highlight, and I will share that with you real quick, is that, let me move back to the other one. Share this tab. Is whenever the market is volatile, where there's losses today, there's gains tomorrow, there's losses next week, and there's gains again, what we're really trying to say is, I need to have an investment perspective that performs well in every economic climate and doesn't perform well in certain economic climates. So I'll give you a quick example and then I'll go over the 3 portfolios. What you can see here is that we have, during times of prosperity, economic growth, normally stocks perform the best Because if everybody's buying, if everybody's growing, then me investing in blue chip companies, growth companies, small caps, all these are fancy words. Say blue chip normally means 10 billion or more. These are going to be the companies that have been around literally for 100 years, probably not going anywhere. And then when we say small cap, those are normally going to be the companies that are over 100 million, but they're less than 10 billion. If you're under 100 million, probably in penny stocks. So God help us all, right? Don't you normally your market cap don't be under 100 million. And so if I'm investing in stocks, they're normally going to be prospering. Everybody's doing well. Businesses are hiring. Businesses are growing. But I accept the fact that if there was a recession, then I would do better to have my money in cash, right? So if you've been reading Warren Buffett, famously known for having a whole bunch of cash right now, because he feels that we're about to go into a recession and he wants to buy these stocks at a discount. So if you're holding stocks, then they're going to be losing value. If you're holding cash, while it's not losing or gaining, value outside of inflation, he knows that he's going to buy a certain list of amazing companies that are going to be at a discount. And so he's holding cash for that. We could do the same thing. So in a recession, cash normally does pretty well. Inflation, if there's times where the dollar is worth less, you and I already know, where do people normally hedge against inflation? Normally gold. You can also consider real estate. But normally then in times of inflation, I have gold that's going to do well. Times of deflation, right, the opposite, then long-term treasuries do well. And so if you're basically sitting there saying, if I know that there is an asset that performs very well in every economic climate, then if I don't want to be thinking about this a lot, I just have to build a portfolio where I have a portion of it that performs well in every economic climate. And then I need to know which climates that they perform well in. Like, for example, I know real estate normally does well in times of prosperity. So that's normally going to be a good place if you're talking about economic growth. And so we would be like, all right, cool, I can do that. I know that normally when you look at economic cycles, if we're doing really well, then that normally means that interest rates are probably low. Right? Just generally speaking, they're probably low, which means it's also going to be a rough time for me to be invested in treasuries because the interest rate is really low. I'm getting a really low return because all the interest rates are low. And so we can feel out where I should put my money in these different economic environments. Normally, what we'll end up doing is we'd say, all right, I know that I have to put together a portfolio that at least outpaces inflation. Dre talks about inflation all the time. So what we would normally do, and I'll share the link with you, it's just portfoliocharts.com. I try to find places that aren't like the material that I have, right? Because inside of Schwab, who is my custodian, I have a lot of data and information that I think would be a little overwhelming. And it wouldn't be very beneficial for you because you don't have access to it. But this is somewhere that's free for everybody, portfoliocharts.com. And then we'll look at this first one. This is called a permanent portfolio. So you can see that we have 25% in large caps blend, you have 25% in long-term bonds, 25% in gold, 25% in bills, right? So large cap, we just talked about that, companies over 10 billion, and that's going to be in the stock market. I have those four assets that we talked about. How do they historically perform? Again, historically speaking, we know that it does not predict the future, but we do know that it at least gives us information to make an intelligent, informed decision. And so the way you would read this chart is we're saying from 1970 to 2024 that 27% of the time this portfolio loses money, but that 73% of the time this portfolio makes money. And that on average, it's about a 5% return. So I'm able to keep up with the average inflation of 3%, which is generally what we're looking for. I can see that about 55% of the time, my portfolio is going to be somewhere in that 0 to 10% range, averaging the 5%. I can see that about 20% of the time I exceed that, and I'm making somewhere between 10 to 20%. And then there is a very small 5% of the time that I'll make more than 20% with this portfolio allocation. When I lose money, the 27% of the time I lose money, I can see that about 24% of the time, I am going to lose somewhere between 0 and 10%. And that's about, let's say 5% of the time, I'll lose more than 10%, 10 to 20%. So I can see that the majority of the time, over 70% of the time, which most of the time I'm making decisions, I accept the fact that I'm not going to get it 100% right, but I need to be able to put myself in a position that overwhelmingly the majority of the time that I succeed. And so you can see that as a result, about 73% of the time, I'm going to make money. And then even in that 24% of the time, I'm not going to lose that much. As a result, that means that this portfolio is something that in most market economic cycles, as you've seen since 1970, so we've gone through the all sorts of crises, 9/11, the dot com, you went through the recession, the Great Recession, COVID, went through even coming off I mean, I think you have the oil crisis is in there. So we have a lot of events and we're still okay. So when I'm saying that, I'm like, all right, this is a option for me. Now, this is not something I would probably lean into. I would say if you were maybe 20 years from retirement, but this is definitely something that as I get closer to retirement, I can I can protect myself. Now, we don't have to go through all of these. It's a whole lot of information, a lot of data if you like them. They just show the same information in a variety of different ways. And so, what we're basically seeing, right, for example, here, this is simply saying that the times that we're at red is when I lost money. And we're looking at the different years and it's showing you what you would have received as your return over the time. It's just expanding on the overall data. And that 2024, this portfolio is outperforming its average. It's at 9%, right? So 2023, 2024, you can see that in 2021 and 2022, it didn't do very well. And so that's what this chart is showing. All this is just a variety of information to show the same information. So I think you get the point. I will show you another one, and we'll get progressively a little bit more complex. And so the second one I'll show you is the all seasons portfolio. And it's just as the sort of sounds, all seasons. So this is one that Ray Dalio put together. If you read, I forget, it was one of Tony Robbins' books. I think it was like The Money Game or something. Ray Dalio is a hedge fund manager, phenomenal investor, a macro investor. Very fancy way of saying that he looks at patterns and trends in entire countries, and then he knows where to invest and not to invest. And so he shared a high level, watered down version of one of his approaches. Naturally, it's safe to say he's not using this approach right now because, just like most things, if everyone is doing it, it removes what we call the alpha. It just means the edge. It removes the edge if everyone is doing the exact same thing. And so he probably doesn't use it now, but he uses 30% domestic stocks. Domestic means US companies, 40% long term bonds. He has 15% in intermediate bonds. He has 7.5% in commodities and 7.5% in gold, right? And so he says that this gives him the ability to have a portion of his portfolio that performs well in every economic climate, right? So this is how he is hedging. And so we'll go down, we'll do the exact same thing where we'll take a look and see how this is performing overall. And so, all right, it's taking a second to load. All right, and so we have the same thing. It says 5.2% is the average return. We can see that it's under 50%, so it's not as where it's still about 75% is going to generate you a positive return, but you can see that it's going to generate you a slightly higher return because you have more risk. You have much more of your assets, assuming that there's going to be economic growth, and that's okay because the majority of the time, if you look at the data, a recession is about once every 10 years. So that means the majority of the time it is economic growth. So if the majority of the time is economic growth, when you are hedging against losses, that obviously means that we're limiting the gains in our ability to limit the loss. And so he's leaning towards the growth. And so that's why he ends up being able to capture more of the growth. So 20% of the time he generates 10 to 20%, or at least this portfolio. And then about 5% of the time he can generate over 20%. 75% still positive, about a 5.2% return. When you lose, you have about the same 21, 22%. It'll be less than 10%. And then about a 2% chance to have it about 10 to 20% loss. And then there's a 2% chance to have a 20 to 30% loss. So you can see how the more opportunity we give ourselves for growth, the more opportunity we give ourselves for losses. And so that is how this portfolio is shaking out. This will be one that you definitely could use as an allocation, and then you would maintain it. And then you would be able to maintain this even if you're probably 10 years out from retirement, where you would still be okay. And then the last one I'll show you as far as where to put your money in so that you can be comfortable leaving it in. And then let me actually, before I go over this one, let me just see if you had any questions in the meantime to make sure. Okay, so I wanted to make sure everybody, hopefully this is making sense. Is this making sense? You give me a thumbs up or something like that. Just let me know it's making sense, because we are going in the weeds, but that's what it takes to be able to deal with these market swings. You have to have a plan in place that helps you to maintain it. All right, so the third one that I'll show you is called the 7-12 portfolio. And it is a little bit more complex. You're in more asset classes, but then it's still leaning towards growth. And we're opening ourselves up to a little bit more risk. And so what do I mean when I say that? 12.5% large cap. As we mentioned, companies over $10 million probably not going anywhere. 12.5% small caps. These are companies about 100 million to maybe like 5 billion. And they do swing a lot more because they're not as stable and as large. International stocks. So now we open ourselves up to the international market. And naturally, that obviously gives you more risk naturally. Emerging markets, that is going to be a subset of just opening yourself up to international markets, but these are going to be economies that are growing. So that emerging markets could be like India or China, where there is significant growth in these developing countries. That's your emerging markets. And then you have 17% in intermediate bonds, 8.3% in international bonds. You have the 8.3% in cash, 16.6% in commodities, and then REITs, real estate investment trust, you have 8.3%. So I have opened myself up to emerging markets. Naturally, if you're able to find some of these great countries that are growing exponentially, it gives you a really good opportunity to ride some of this growth. This is going to be something that we're probably not within 10 years of retirement, but it is something that is a strategy that we're able to use where it allows us in these times of economic volatility to say, you know what, I'm okay. I have a position that's going to do well in every climate. And as a result, I'm comfortable maintaining this. And so we will go down and we'll see how this one performs. And so you can see that on this one, we've given ourselves about the same 75% for growth. I have about 42% as far as 5.7% on average. So my 0 to 10%. By 10 to 20%, I'm about 27% of the time. And then close to 3% of the time, I'll make more than 20%. And so you can see that gives me a high average. Now I'm closer to 6%. And then of course, when you're taking the larger growth, you're opening yourself up for the larger losses. And so you can see that that's changed as well. Where my losses on the loss years, 0 to 10%, it's actually about 17% of the time. And now I'm up to 5% for 10 to 20% losses. And then I still have that 2% for 20 to 30% losses. I've opened myself up more for growth, and you can see that in my growth years. I open myself up more for losses, and you can see that in the loss years. That is going to be a personal decision for each one of you, but you can see that what all we're saying is that this is how it performs, from 1970 to 2024. So we're talking about over 50 years. This is how this allocation has performed. And again, you can find these charts at portfoliocharts.com, and you'd be able to do that there. All right, so that is where you put the money in. How do you feel about that so far? Hopefully you're feeling pretty good. So now that I know where to put my money, and I got the first half done, where do I put my money? Then I need to make my second decision, which is how do I take the money out? And so let me close some of these tabs. So we're done with the sequence of returns. We're done with leaving your market in there instead of timing it. And then I did want to share with you actually one more. This is one of my favorite little places to play it. I know I'm a dork. I understand. It's okay. But I love going to, it's called novelinvestor.com. And I'm going to share with you, it just shows the S&P 500 sector performance, where if you just chose one sector to invest in, and you could literally Google any one of these sectors and put the word ETF at the end of it, and it'll show you that in the world of index funds, you don't have to just be indexed to the NASDAQ or indexed to the S&P 500. You can definitely say, you can definitely be indexed to a sector. So you can say consumer staples index, and that's basically all they're doing. They're looking at the indexes. And you can see that over time, it shows you how each of these sectors perform. And one of the things I like to show people is if you're always making your decision based off of last year's winner, you are most likely opening yourself up for loss. And the reason is we call that is because there is volatility. A very fancy way of saying that, yes, I just showed you that these portfolios, right, they average a 5% return, but you saw that it has a variance. It has a range where it could be a plus 30, it could be a minus 10, and over the life of it, the average is 6%, which means that if that particular allocation generated a 30% gain last year, it's more likely, if it has an average of 6%, it's more likely that it would actually generate a 24% loss next year, because that would give me the average of a 6% gain. And so you can see that real estate in 2010, that was the best performer. If you were able to choose that index, you made 32% last year. or in 2010. But you see that it dropped the following year to 11.4, and then it went up, and then it was the very worst performing in 2013. It was 1.6% was its return. And then from the literal worst was the worst performing index in 2013, what did it do in 2014? You're right. It went back to number one. It was the best performing index again. And then what did it do after that? You can see a couple years later in 2016, it was back at the bottom, 3.4%. So you can see that when people are normally making a decision based on how something performed the previous year, you can see that that is not going to be the best tell. And that's one of the reasons that we can't be out here chasing yesterday's wins, because you almost locked in your loss because you're doing the opposite of what you're supposed to do. If you're chasing yesterday's win, that means you're buying high. And then when it becomes next year's loss, you're then going to sell it, which means you're selling low, which is obviously going to lead to us going broke. But you can see that variance. I won't worry about now because the yellow is so hard to see. But you can see that we have some that are performing really well, and then they're performing really badly. So this is energy. You see that it's performing really well, and then really badly, and then really well again. That you have to have a consistent plan and approach that stays the same throughout most of these economic climates, which requires you to have a plan that you're comfortable with. And so the last thing I'll show you, and then we'll get on to your withdrawal strategies. You can see here, all we're basically saying is, look, on average, this is a 16% return from 2010 to 2024, and the best was 43%, the worst was 37% loss. You see that the consumer staples, it's just, it sounds like staples in our household. So it could be like groceries and things like that that we just have to get, toilet paper, toothpaste. It has an 11% return, and then you can see a 20%, 27% gain is its best year, and then an 8.4% loss was its worst year. Energy sector is 65%, 66% gain is its best year, and its worst year was a 34% loss, which then averages you what, to a 6% return. That is going to be a tough sector to be invested heavily in, because there is such a huge swing. I think most of us would be up late at night and pretty uncomfortable with that. But you can see, right? You can see what I'm saying is you're not going to be out here just picking a sector and then be like, oh, I feel good about that. It's going to, every single sector is going to be at the top and the bottom. It's going to switch all the time. And so we want to make sure that we're super comfortable where we have a diversification approach, a diversified approach, where we know that there's a portion that does well in every economic climate, and it's going to give me an average that I can live with. So limiting the volatility, where I'm not gaining too much, I'm not losing too much, enough that I can stay comfortably in my investment over the long term. Because as we just said, it's a long-term game. Yeah, when you put the money in, you leave the money in, and then you only change the allocations when you feel a complete shift, either in your goals, your time horizon, which means when you want to retire, and your life circumstances. But as far as the market as a whole, we put in the plan, understanding that the market is going to be a little crazy, it's going to be irrational, and we just stick to the plan. All right, so with that, let's close out when to take the money. So there are a lot of withdrawal approaches that you can use. I am someone who likes to use the bucket strategy. I think it helps a lot as far as the overall stability and the approach that we can do. I'm going to leave it up to you to choose the approach that works best for you. And there is, for example, you could be someone that says, Drake, I like the 4% rule. And 4% is just as it sounds. I could say, all right, I got $1 million in my account. I take out 4% every year, and that's going to be $40,000. Right? So that's the 4% rule. You could be someone who would say, I then the next year, if inflation, so basically what we're saying is if inflation is 2%, then what I would do is I would account for that 2% in my next year's income. And so I think 2% of that would have been like $200. So next year, you would then take out $40,000 and then 200. You just account for whatever the inflation is, and then you just take the inflation amount each year going from that. Right? So that would be the 4% rule. A lot of people use that. It's very simple. It works for a lot of people. Another approach would be the guardrail approach. And all we're going to do with the guardrail approach is we're going to say, all right, some of the years the market's going to go up and it's going to go up a lot. Some years the market's going to go down, it's going to go down a lot. So I'm going to set myself up with that 4% return, right? So I'm going to say like $40,000. But if next year, or like, so basically this year, the market went up 20%, then I'm going to increase how much I would take out the next year. So we're not gonna go crazy, but basically we have a floor and a ceiling. Right. So if I have a floor, so no matter what, if the market does really bad, it's okay. I'm going to at least take out 2%. And if we say my ceiling, and I believe it's the EI, I'm going to say no matter what the market does, I will never take out more than 8%. So that way I can leave in some of the extra growth for the down years. And then even on the bad years, I can limit how much that those sequence of returns and things that we talked about, I can limit how much this loss year impacts my portfolio. And you would say, okay, so on my great years, I'm going to take out 8%. So on this one, you would do that. You would say, all right, well, so next year, I'm not going to, even though I made 20, I'm just going to take out my 8%. And so assuming I still have my $1 million in there, so next year I live off of $80,000, right? Because that's my 8% ceiling. And then if it was a down year, you would do what we mentioned, where I would do my floor. And so my floor is 2%. So the next year I would have only taken out $20,000. So that way I could limit how much those losses impact my portfolio. Now, this is the reason this one's obviously a little bit tougher and people don't like it as much is because you have to do the calculation every year. So you have a little bit of volatility even in your income, but you're trying to manage the volatility of the market. And so that's why some people like the guardrail approach. Another one I've seen, and I'm going to end with the bucket strategy. I'm just going over some of these so at least you have an idea of some different withdrawal strategies. The truth is, there's probably like over 10 of them, but there's maybe like 5 that most people end up choosing between. Another one would be called your income strategy. And all the income strategy is basically I have a certain amount of money that's in dividends. I have some money that's generating me a rental income. And then I have some money that's generating some interest from the investments. And I'm going to take the income from all of these, and that is what I live off of in a year. I never touch the actual $1 million. So my portfolio, so the income from my dividends, my rentals, and my interest, if that generates me $50,000 a year, then that's what I live off of. If the income generates me 70,000, yeah, that's what I live off of. And if the money number goes down, then that's what I live off of as well. I never touch the principal. Now, those that like this approach, there's really a couple things they're thinking. Number one is I'm thinking generational wealth. I want to make sure that I leave something for the next generation. I want to make sure my kids or someone does that. The second thing that they're thinking about is there's no way I'm going to run out of money, Dre. I haven't touched the principal. I'm only spending the income that my assets are generating. So how could I run out of money, right? As long as these assets maintain, as long as they remain, as long as my dividends, these companies keep paying dividends, as long as the people living in my rental properties, they keep paying rent, and as long as even in your profits in your business, where you're like, I'm not selling the asset, I'm just taking the golden egg, right? So I'm not selling the golden goose, I'm just taking the eggs. And so some people like this approach as well. Now, it takes a little bit of preparation where you probably made this decision early on in your retirement because we got to start building these assets up. A dividend income stream that can generate you the income that you want for your retirement, that's going to take a little bit of time. And so if you have that, and that's fine, we can work towards that. And then your rental income, the same idea, you would need the down payment and get the rentals and all that stuff, but you can have this income stream as well. So this is another one that people do like too. All right, so let me move on and I will show you the 3 bucket strategy. Right, isn't that great? I love that it scrolls down. I love that so much because I don't have to erase anything. So the 3 bucket strategy, and the reason I like it so much is because it lets me sort of combine the best parts of all of them, if you really think about it. And I'm not saying this is the only approach. I just showed you many of the other approaches, and they're all doable. So the reason I like the three bucket strategy a lot is because I'm going to have my assets. I'm going to have these. So you're gonna have bucket number one, and that is going to be your cash and your cash equivalent. So that's my liquid money. This is normally going to be 1 to 2 years. And the reason we do that is because this is my living expenses. If I'm dealing with market volatility, if I'm uncomfortable, if I'm worried about sequence of returns, if I'm worried about all this stuff, I give myself at least 2 years of runway where I don't have to take any money out of the stock market. I can allow it to recover from whatever I'm dealing with. That if you think about the Great Recession, you think about COVID, 9/11, that 2 years of runway, it's very unlikely that any of these events were still that negative, or that we started the recovery, that we were moving in the right direction. So that gives me 2 years of cash and cash equivalent. All right. So that could be someone's CDs could be in there. You have your money market accounts in there, right? All my cash and cash equivalent. This is normally going to be what we consider our safe investments. And then you have your moderate. And this is normally going to be my income. So this is my income generating bucket. So this is bucket number two. And we're normally going to be 3 to maybe 6 years. It could be 5, it could be 6. But my moderate bucket is going to be things that I know I'm taking a little bit of risk. Hopefully I'm keeping up with inflation. And because I'm doing that, I don't need as much of a runway. That the lows aren't that low and the highs aren't that high. So I'm sort of in the middle, and it's okay. 3 to 6 years, I'm okay. And so normally what we'll have here, it would be anyone that has some sort of an annuity. You can actually have balanced mutual funds here. You can have any bonds, right? That's just debt. It could be government debt. It could be a company's debt. And for those that don't know, or be bad at me. So when I say balance, what we're saying is, 50%. Oh, 50% in stocks, and you have 50% in bonds, like 50% in debt, right? So that's balance. Balance, right? Scale is balance. Right. So you have that. You can have your annuities. I'd probably consider, right? So your income could be naturally your Social Security. And the reason we don't put that in safe is because Social Security is actually not a slam dunk, right? You and I both know it's not a slam dunk. And so you have that, and then you could also have your pension. So that's going to be my moderate investment. I'm going to take this bucket and replenish this bucket as long as this market is doing well. If this market is doing well, then I'm going to replenish this bucket. If the market is not doing well, I'm going to hold tight on this bucket as well. Then I'll just spend out of my safe bucket. When you're selling in your moderate bucket, you can just sell periodically to refill your safe bucket. It could be once a quarter, once a year, however you want to do it. But normally, if you have times of economic growth and you feel okay, then you replenish it. If it's an annuity or Social Security or pension and there's nothing you can really turn off, then you're replenishing it with that as well. And you're just taking this money, you're generating these income streams, and you're going to be in a good spot. Okay, let me clean this up a little bit. So I can move that. All right, well, I clean it up. Is this making sense to you? Is this making sense? Hopefully it is. Okay. All right, so then we're going to move on to our bucket number 3. This is our aggressive bucket. And so we are focused on one thing and one thing only in bucket number 3, and that is growth. And because I'm focused on growth, I need a little bit more runway because we just saw the market volatility. We know that there's a portion of our portfolio that's going to perform well in different environments, and I need the time for that growth to come back. That if we're dealing with issues in a recession, I don't want to have to sell those investments during a recession. I would ideally love for them to gain all of their growth back and even some extra growth. That means we normally are going to need probably at least 8 years, but I would say shoot for 10, right? Shoot for 10, but it could be 8, and that's fine. So 10 plus years. So that would be your business. I would say that would be your real estate. The way that I do aggressive is it means I could go to 0, right? So that could be it. And then you would have your any individual stocks that you have, and then any ETFs and aggressive growths that you have overall. That is going to be my growth. I'm focused on growth. I'm trying to get that 8 to 10% return on these investments. And then you do the same process. That over a span of 10 years, if the market is down, I sell nothing in here. If the market is well, I move the money to my moderate, and then basically what we're saying is I would take, if it's real estate, I would take my rental income and I would buy some bonds. And then I would sell my bonds and I would either take the cash or I would buy CDs. That's what I mean when I say you would sell from the bucket to buy the next bucket. And so then in my growth, I would do the same thing. And then I would move my allocations just like that. And so, however, the way that you would normally set it up is that's how we're looking. And so I could, if I had stocks, then whenever they're growing, I would sell my stocks, whatever my aggressive stocks are, and then I would buy a balance fund. And then the same deal. So then when the market's doing well, I'd sell my balance funds and I would buy a money market account. And then I would just keep moving my funds down. And then whenever we're in a recession, high market volatility, I'm uncomfortable, I don't know what's going to happen, I hold tight. I just live off of my safe and I wait for the market to clear. I just wait for everything to go, because as you just saw, if you miss the 10 best days, then you've already limited your growth to just 3% over a 20-year span, at least historically. Now, obviously, I can't tell you what's going to happen in the future, so don't say I did. I didn't tell you to do anything like that. And so you can see, all right, so that's great. All of a sudden, I'm able to put a variety of these withdrawal strategies together in my approach. And then you would be able to do that. So this would be what you would do to limit the market volatility. You're not dealing with that uncomfortable feeling like, I just don't know what's going to happen, because you have a long-term approach. You got at least 2 years for your liquid accounts. And then as the markets come back, you would then you'd reinvest it. The main thing is, if you're dealing with market volatility, don't just leave the market altogether. We do have to have something that's working on growth. That we can't just put all of our money in a mattress under our bed, because you and I know, because of inflation, I just did on my last video, I talked about the price of eggs, and we were talking about the price of eggs over a span of 20 years, which is not crazy for anyone to be retired for 20 years. Where in 1970 it was 61 cents for a dozen eggs, and in 1990 it was $1.01, almost doubled in price. That a gas was like $1 in 1990s when I was a kid. And then when I went to college, gas was maybe like $3 a gallon. That was almost triple the price. So we can't say our plan is like, well, market volatility, I'm going to deal with losses, I just won't be in the market. We're dealing with a different kind of risk when we're doing that. So we don't want that to be our overall approach. So let me see if there are any questions, and then we'll be able to go from there. We'll be in a pretty good spot. All right. Let's see. Waiting. And while we do that, I'll make sure that I have everything that we're good with. All right, good deal. And I think everybody was able to see it, so then we're in a good spot. All right. If you have any additional questions, feel free to reach out to me. You can definitely set up some time to get on my calendar, and we can have a complimentary, like 45-minute, 30-minute discussion on your retirement plan if you're just not 100% comfortable with your future, where there's a little bit of uncertainty, you just want to have a second opinion. Then I do give complimentary discussions. You can see here at calendly.com/wisdom metrics. I put a link in the show notes as well. And all you'll do is you would just come here, plan my retirement with confidence. You'll just click on this, and then you would schedule yourself some time to get on my calendar, and we would have the discussion from there. As always, I'm thankful for your time. If you haven't already, don't forget that my book, Wealthy Retirement Wisdom, is available, and you can go ahead and get yourself a copy. I have it right here. So my book, Wealthy Retirement Wisdom, and if you've already gotten it, because I have seen some people get it, go leave me a review, please. Right? So that would be great. I would appreciate that. And then if you have any additional questions, I'm always here for you. Until next time, stay safe and enjoy life.